two investors get the same paycheck, the same $500 a month to invest in the same 30 years. Investor 1 starts today. All-time high, scary headlines, doesn't matter. 500 goes in, every month, rain or shine. Investor 2 is smarter, or at least he sounds smarter. The market's expensive right now, he says. A crash is coming. I'll wait and buy everything at a discount. 30 years later, the patient genius retires with hundreds of thousands of dollars less than the man who never once checked whether it was a good time to buy. And here's the part that breaks everyone's brain. Researchers ran this exact game with a player who had actual superpowers, perfect, impossible knowledge of every market bottom. Even he barely beat the man who just started. This is the math of waiting for the crash, why the discount almost never comes, why it isn't a discount when it does, and what the waiting itself quietly costs you. Down to the dollar. Let's be fair to Investor 2 because his logic is seductive. It's built from the most famous sentence in finance. Buy low, sell high. The market just hit another all-time high. Every instinct says that's a ceiling. The news is full of people in suits predicting a correction. The news is always full of people in suits predicting a correction. Buying now feels like paying full price the day before the sale. So waiting doesn't feel like fear. It feels like discipline. He's not spending the money. It's sitting right there in his savings account, ready to deploy. He checks the market, sees green, and nods. Any day now. But hiding inside this plan is one quiet assumption doing all the work. That the crash price of the future will be lower than today's price. Hold that assumption up to the light. Because the entire strategy lives or dies on it. And historically, it dies. Start with what waiting actually costs because everyone calculates it wrong. Investor 2 thinks skipping a year costs him year 1. The pathetic year. We measured it 2 episodes back. Back in the 100K video, your first year of $500 a month earns you about $200 of growth. A snowflake. Who cares about losing a snowflake? But that's not how compounding works. A 30-year machine that starts 1 year late doesn't lose its first year. It loses its last one, the biggest year the machine will ever have. Run the numbers. $500 a month for 30 years, about $1.13 million. The same plan started 1 year later, about $1.017 million. 1 year of waiting for clarity. Costs $113,000. Not the snowflake year, the avalanche year. Every month you stand on the platform, it's the best train of your life that leaves. Fine, says Investor 2, but when the crash comes, I'll make it all back buying cheap. Here's the problem. Crashes are real. A 10% correction arrives roughly once a year. A 20% bear market every 6 or 7. He's right that a storm is coming. He's wrong about where the prices will be when it lands, because markets don't crash from where they are today. They crash from wherever they've climbed to by then, and historically they spend most of their time climbing. Picture it. He waits 3 years for his moment. In those 3 years, the market grinds up 30%. Then the crash finally arrives. A real one, down 20%. He pounces on the discount. Do the math on his discount. Up 30, then down 20. Leaves prices 4% above the day he started waiting. He waited 3 years, survived a crash, timed the bottom, and paid more than the price he originally refused. The sale price was higher than the sticker. The trigger for all this waiting is usually one phrase, all-time high. It sounds like a warning label. It isn't. It's a description of how markets work. A market that grows over time doesn't visit its all-time high once, like a comet. It lives there. New record highs show up dozens of times in a normal bull year. They're not the top of the mountain, they're the trail. And the data backs this up in the strangest way. Historically, returns after investing at an all-time high have been just as good as any other day. Over many stretches, slightly better. Because record highs cluster. Strong markets keep setting them, one after another for years. So, I'll wait until it's not at a high often means waiting for a day that mostly doesn't come, while the highs keep stacking, each one making yesterday's too expensive look like the bargain of the decade. The ceiling you're afraid of is usually the floor of next year. Now the experiment from the hook, the one with superpowers. Researchers have run this simulation over decades of market data, and the setup is beautiful. Same yearly money for each player. Player 1 invests immediately, no thinking. Player 2 is divine. Every year, he somehow buys at the exact market bottom. Perfect timing, every single time, for decades. A skill no human being has ever had. The god of timing wins, of course, but look at the margin. Less than 10% more than the guy who invested instantly and never looked. That's the ceiling. Perfection, actual impossible clairvoyance, is worth single digits. And the player who waited in cash for pullbacks, dead last, by a mile, behind everyone. Related studies put a number on the simple version. Investing available money today beats easing in slowly, or waiting about 2 times out of 3, roughly 68%, if perfect prediction barely pays. What exactly is your prediction worth? And there's one more character in this story. You met him 2 episodes ago. While investor 2 waits for his moment, his money isn't paused, it isn't neutral, it's sitting in a savings account. Which means the thief from the inflation video visits it every single night, taking his 2.5% a year in real purchasing power. Guaranteed, no crash required. Waiting in cash sounds like standing still. Mathematically, it's walking backward. Slowly, politely every year, but the cruelest cost isn't even the thief. It's what waiting does to his head. Every month, the market climbs. His entry price anchors further into the past. He remembers when the index was cheaper. So today's price feels insulting, and next month's feels worse. The longer he waits, the harder starting becomes. Waiting for the crash was supposed to be a strategy. It quietly became an identity, the man who's always about to invest. There are people who have been about to invest since 2 crashes ago. Quick honesty break. You know the drill. First, 10% is the long-term historical average, not a promise, and 68% means investing today loses to waiting about 1 time in 3. Sometimes the crash really does come early, and for a while, the waiter looks like a prophet. Averages don't erase lucky exceptions. They just tell you which side to bet on. Second, this is about long-term money. Your emergency fund stays in boring cash, thief and all. That rule from the inflation episode hasn't moved. Third, yes, if you drop everything in the day before a real crash, it can take years to break even. That's true, and it's exactly why the series has never told you to time a lump anyway. $500 a month is the strategy. Monthly deposits buy the crash automatically without predicting it. The principle survives every caveat. You don't need to know when the storm comes. You need to already own the farm when the rain arrives. So let's write the bill for waiting. Start today. 1.13 million. Wait 1 year for clarity. 1.017 million. The market charged you $113,000 for that clarity, which, by the way, never came. Wait 3 years for the perfect crash. $823,000. $307,000. Gone. Does that last number sound familiar? It should. 2 episodes ago, the man who checked his portfolio every day paid almost exactly the same price, $300,000, for watching too closely. Look at those 2 men side by side. One acted too much. One never acted at all. Opposite mistakes, identical bill. Because the market doesn't charge you for being cautious or being obsessive. It charges you for the same underlying thing, believing you can outsmart time. Fear has 2 costumes. The scoreboard can't tell them apart. So here's the uncomfortable truth about Investor 2. He was never really waiting for a crash. He was waiting for certainty. A big flashing sign saying, it's safe now. And certainty is the one thing no market has ever sold at any price. There's an old line about planting trees. And the math in this video is just that proverb with a spreadsheet. The best month to start was years ago. The second best is this one. Every option after that costs 6 figures. This whole series is one machine. Start early, Climb the levels, survive the boring stretch, ignore the noise, outrun the thief. Today's lesson is simply the ignition rule. The machine can't protect money that never got in. If you want to see the other $300,000 mistake, the one people make after they start, the Daily Checker video is next. Same bill, opposite fear. The crash will come. Invest anyway. That's the whole video.